All right, I have the top of the hour. Good afternoon and welcome to this session in our 2025 Yellowbook training series. My name is Chelsea Kim with Sikich University, and I will be on to support you all today. We also have Rachel Hawley with our marketing team on with us. She and I will be screening any questions and comments that come in. For CPE today, we do have 3 polls. As they come up during the session, please complete all 3 polls in order to obtain CPE. If you are joining us via browser, make sure that you have it set to full screen as the polls can be hidden if you have it minimized. You can expect this CPE certificate in about a week. A copy of the slides for today's session are in the materials section. This recording will be made available on demand in a few days following the event. An email will be sent to you with that information. For this session, we welcome back Matt Geerdes and Tom Sawicki for part 2 of the GASB update. Matt, a principal, is a public accounting leader with nearly 24 years of experience providing auditing and consulting services. He works closely with entities in the government and not-for-profit sectors, including municipalities, state agencies and state universities, community colleges, school districts, special districts, and educational foundations. Tom, a director, has experience working in the public accounting industry since 2009. He is responsible for managing the execution of audit engagements and supervising the audit team. He provides assurance services and recommendations for improvements to local government and manufacturing and distribution clients. Thank you again for joining us. I will hand things over to Matt and Tom.
All right. Thanks, Chelsea. Good afternoon, everyone. Thank you for joining us today and taking some of your time to be with us here. Again, my name is Tom Sawicki, director here with Sikich on our local government services team here in our Naperville office. Been with Sikich for about 16 years now, working on a variety of local governmental entities, all of which will be impacted to some degree by the pronouncements we're going to be covering in today's session. So happy to be here with all of you to continue our monthly Yellowbook webinars. Also here today is Matt, and I will turn it over to Matt to introduce himself.
Sure, thanks, Tom. Matt Geerdes, principal with Sikich's local government services team. So, as Chelsea alluded to, I've been in practice now for close to a quarter of a century. So I've been and seen a lot. There's been a lot of things that have come through the GASB pipeline over the years. Some of them have been major changes. Some of them have been ones where there have been, some impacts here. And Tom has, hit the nail on the head. These are 2 standards that are going to have some impacts pretty much across the spectrum. So pleasure to be talking to everybody and really excited to get diving in. So I think first things first, let's go back one slide. Do all that legal stuff that's here. So, this is just a disclaimer that we have to do. You can read it. It's in the materials at your own discretion. This is all that stuff about bearing responsibility, about accuracy, legality, content, third-party content, all that fun stuff. So, again, you can read that at your own discretion. So, let's actually get into the real fun stuff. So, there we go. All right. So as I mentioned, we said we're going to do GASB 103, which is the reporting model improvements that came out a little bit ago, and then we're going to dive into statement 104. These 2 pronouncements are the reasons why, when we were determining the Yellowbook series, flow of the presentation, why we're doing this in 2 parts is because the fact that in order to give everything that's come out recently for GASB the appropriate amount of justice, we had to split it up. So, but we're going to have some time during the session for Q&A today as well. So if you want to put those in through the session, we'll monitor those as well. Depending on the timing, we'll address it right away, or we'll probably just save it for the end. So we'll just kind of see how that goes. So Tom, it's you can start driving, so I'll be here.
All right, sounds good. Thanks, Matt. So we're going to start here today with our first polling question. So if Chelsea, you want to launch that.
First question is, has your entity considered the requirements of GASB Statement 103, and how will it impact financial reporting in the year of adoption? So again, please make sure to respond to this in order to receive CPE credit for today. I think we'll just give it a few more seconds. think we have an even split.
Wow, yeah. All right, so it sounds like, yeah, pretty even split between the answers there. Responses ranging from you started looking into the standard, maybe just started thinking about it, or have done really nothing up to this point. So that's perfect though, because as we see here, GASB 103 on the financial reporting model improvements. Matt, if you want to go to the next slide, you'll see the timing here of the standard itself. The statement 103 is effective for fiscal years beginning after June 15th, 2025, and all reporting periods thereafter. So as noted here, that would put the fiscal year and effective dates at June 30th, 2026, December 31st, 2026, and then April 30th, 2027. So then, going back to our polling question, how many of you, really haven't dug too much into the standard? Again, a little bit of time here to start thinking about it and the impact it may have on your organization. So first off, a quick synopsis of the objective of Statement 103. It's to improve key components of the financial reporting model to enhance its effectiveness in providing information that is essential for decision making and assessing a government's accountability. But ultimately, what is the purpose of the standard itself? So you have to go back to the early 2000s, 2001. GASB issued Statement 34 on the basic financial statements and for state and local governments. 34 established the model for state and local governments financial reporting, which we use today, and includes things like the format of the financials, measurement focuses, basis of accounting, certain notes, certain RSI schedules, and then also the management's discussion and analysis section, which we'll discuss here today. So basically, GASB 34 was an overhaul of the then current reporting model used by local governments at the time. So it's been, roughly quarter century, about 25 years since 34 came out. GASB decided that it was important to re-examine the existing financial reporting model because it's been in place for such a lengthy period of time. Not that they just started this process. It's actually been being looked at for quite some time now. If you look at the timeline of the rollout of GASB 103, it's been in the work for a decade or so. However, based on results of feedback GASB received from preliminary reviews, research they did, surveys and roundtables they conducted, GASB really scaled back what was going to be included in the statement here. So the results of the research showed that most of the components of the current financial reporting model are effective, and rather there were just certain areas identified that could use some improvements. So they shifted from taking what they said called a clean slate approach that would result in a completely new financial reporting model, down to just identifying specific potential improvements to the existing model. So a very pared back version of what was potentially going to be issued with the standard. And this is just an example of GASB's process kind of working there in terms of the due diligence that they did and the feedback they gathered in order to reach the conclusions that they did. So although I'm sure most of you are really, really excited about the opportunity to go ahead and implement a completely new financial reporting model, but unfortunately, we're going to have to wait a little bit on that one. So I can go to the next slide, Matt. So since the reporting model was not completely overhauled, what did we actually end up with the standard? So with GASB 103, there were a handful of key components in the reporting model that ultimately was determined could be improved. And those included changes to the following categories here. So first, changes to the management's discussion and analysis. We went into a lot of specific examples actually last month on our webinar. And I'll go through again here today with some additional information there. There were changes to the terminology with unusual and infrequent items. These were previously called extraordinary and special items. Changes to the presentation of proprietary fund financial statements. Changes in information about major component units in the basic financial statements. Changes to budgetary comparison information and how that's presented, and then finally changes to financial trend information in the statistical section. So 6 key components here that were modified with the issuance of Statement 103. And as noted here, there were no changes to governmental fund measurement focus or basis of accounting as a result of the issuance of GASB 103. That was looked at in the exposure draft, but ultimately removed during the re-deliberation process. So no specific impacts to accounting for your governmental funds finances in this standard.
One little thing on that little last bullet is that when the board was doing its redeliberations and they took out the governmental funds measurement focus and basis of accounting adjustment they were originally proposing, and it was going to be a big one. I mean, it was almost, you're right, not just improving and almost overhauling, completely redoing it. The board didn't completely kill this one. So it is in their archives, and they have said that they could potentially bring this back on future projects. So we're not out of the woods yet. But again, this was one that, yeah, thank God, because this is basically like doing like another version of 34 that industry was just absolutely going to love. Sorry, Tom, had to interject on that one.
Nope, thanks. That's good info. So we'll go ahead and get started here with the first key component that was changed. That was the management's discussion and analysis section. So overall, the MD&A's focus should be on current year balances and results of operations in comparison to the prior year. It's supposed to be a fact-based analysis with the main emphasis being on the why. As I always mention when I'm presenting audit reports to boards and councils, is that the MD&A is just as the name describes it. Management discusses and analyzes the financial information. Unfortunately, many MD&As in practice do not focus enough on the whys and the reasoning for the balances and the changes in those balances during the year. Ultimately, they're a bit too generic, missing the actual analysis piece there. Also, any of you who participate in the GFOA certificate program very likely have received comments back from GFOA regarding the MD&A and needing to improve upon like the analysis piece or the explanation piece that's included in there. I know I've seen a number of these comments provided over the past couple of years. And with the MD&A, GASB is seeking to avoid any unnecessary duplicative information, as well as any of that boilerplate type language. They really want it tailored to your specific entity and situation. The MD&A should focus on the primary government. So information in the MD&A should distinguish between that of the primary government and any discretely presented component units. If you do have any discretely presented component units, determining whether you should discuss anything related to that component unit is based on professional judgment and based on the nature and significance of the relationship to your primary government. And then finally, the MD&A now also has fewer required elements as well. So GASB took a look at the overall MD&A and what was required previously and worked to try and simplify it a bit, ultimately looking at how we can make the MD&A better and more useful to the readers. So as you can see, GASB reduced the number of required elements to be included in the MD&A section, going from 8 categories under current guidance down to 5 under GASB 103. So under the current model, we have the discussion of the basic financial statements, condensed financial information, analysis of the government's overall financial position, analysis of the individual funds, description of capital assets and long-term debt, currently known facts, decisions, or conditions of future significance, analysis of your budgetary variations, and then pretty infrequent, but discussion of an infrastructure accounted for using the modified approach there. Under 103, though, we're down to these 5 different categories. The first being the overview of the financial statements. This is an overview of the basic financials and the relationship of the statements to each other. It focuses on the significant differences in the types of information the financials provide. So very similar to what we're kind of currently presenting. Financial summary, condensed financial information derived from the government-wide financial statements, comparing current year to the prior year for both your governmental and business type activities. Detailed analysis section. So this is the part that's really been missing or lacking, both from GASB's perspective as well as GFOA's. This should be an analysis of the primary government's financial position and result of its operations. It should summarize significant changes to both your governmental activities and business type activities, as well as each major fund, and should explain why those changes occurred from the prior year and indicate the magnitude of those changes. Additionally, you should be including any discussions on significant policy changes or economic factors that significantly impacted your operating results. Then we have information about significant capital assets and long-term financing activity, kind of similar to what we are currently presenting. And then finally, the last section should cover any currently known facts, decisions, or conditions. And these would be anything that are expected to have a significant effect on your financial position or are expected to produce significant differences from your current year results. So I wanted to run through an example of what GASB is potentially looking for in the improvements to the key components in your MD&A. So in our first example regarding sales tax revenue, I included an example here of language that may be included in your MD&A. The city's sales taxes increased from the prior year by 0.5%, which was primarily due to an increase in retail sales that occurred. So after reading that, what do you think? Good? Is that not good? Is that sufficient for our purposes of the MD&A? I think upon reading this, we can all probably agree it's not quite what GASB has in mind here. Probably looking for a little bit more information in terms of why the sales taxes increased or why the sales increased. But we can compare this to an example that actually comes directly from the GASB standard. So Matt, if you go to the next slide. In this example, same scenario, looking at the change in sales tax revenue. So we have the largest single source governmental activities revenue for the city is the local option sales tax, which amounted to $279.6 million or 46.8% of the total revenue. Sales tax revenue increased 0.5%, despite a 7.9% growth in taxable retail sales during the year, due to the expiration of a temporary 0.25% sales tax that financed the extension of a Highway 401 spur to downtown. That construction project was completed in the prior year. So how about in this case? What do you think on this one? Good? Not good? Is this sufficient? I think in this case, we probably can agree then. You can see here that there's sufficient underlying information that more, I would say, adequately explains the reasons to the readers to help understand why those balances changed the way that they did. So while that initial example may have indicated that there was an increase in the retail sales that did help drive that increase, there's a lot more going on kind of behind the scenes that's factored into this change during the year. You actually had a decent increase in the retail sales of about 8%, but this was offset by a reduction in the additional sales tax rate that was being charged in the prior year. So again, we should be looking at it from the perspective of trying to explain the reasons why balances changed in order to help assist readers in their understanding of your financial statements. So next, key component we'll go through for GASB 103 addresses the new terminology that we have to use. Previously called extraordinary and special items are now referred to as unusual or infrequent items. So the definition does not change. So any transaction that would fall under this must be considered unusual in nature and infrequent in occurrence. Unusual in nature means an event or transaction is abnormal or significantly different from the ordinary and typical transactions that we see. And then infrequent in occurrence is an event or transaction that is not reasonably expected to occur in the foreseeable future. So typically a pretty high bar to clear where you would need to present these in your financials. But if you do find yourself in a situation with these in practice, for presentation purposes, you're required to show them as the last items before the change in net position or change in your fund balance. And then if you have multiple items that fall into these categories, you present them gross and not net on your financials. And then finally, you would then disclose in the notes to the financials the programs, the function, or the identifiable activity to which the unusual or infrequent item is related to, and then whether or not that item is within the control of management. So next year, we'll take a quick look at an example of a situation of an unusual or infrequent item. So in this instance, we have a disaster recovery grant that's intended to help a government recover from an unusual or infrequent natural disaster. This recovery grant is an inflow. And then the entity also has an impairment loss from damage that was caused by the same natural disaster. And this is considered our outflow in this situation. Next, we have the example of the required footnote disclosure that you could use in this scenario. So you can consider something like this. The city experienced a flood during March of 20X5 that was a catastrophic event outside the control of management. The city incurred expenses to clean up flood damage in the amount of $10 million attributable to the functions of public works and public safety in the amount of $8.35 and $1.65 million respectively. The city also received $2.5 million in grants from the state to assist with the cleanup effort. So this clearly lays out what the infrequent or unusual items were in this scenario, what the circumstances were, the inflows and outflows, the function to which the unusual or infrequent item is related to, and then ultimately it's outside the control of management. And then lastly, to kind of close the loop here on our discussion on the unusual or infrequent items, here is what it may look like from a financial statement presentation standpoint. We're presenting it here as the last items before the change in net position or the change in fund balance. So as we see here, typically we'll have that other financing sources and uses section is going to be the last section we present. But in this case, we have that unusual or infrequent item section that we present after that OFS section. And then in this case, we have the multiple items that fall into the unusual or infrequent categories. So we'd show them separately at gross amounts. Again, we have our $2.5 million disaster recovery grant presented here. And then our $10 million outflow related to the cleanup costs, again, presented separately at the gross amount. All right, next we will jump into the third key component that GASB Statement 103 looks at, which is the presentation of the proprietary fund financial statements, and more specifically looking at the statement of revenues, expenses, and changes in net position here. Three key changes to be aware of with 103 and your proprietary funds. There was an update to the format. So the layout of the statement has been revised to improve clarity and consistency in reporting. This affects how information is presented as well on the financial statements here. There was a redefining of operating and non-operating revenues and expenses. So the distinction between operating and non-operating has been updated, and each of these definitions has been modified. And then there's a new category as well, subsidies, that's been introduced. These are amounts received to support ongoing operations, such as general fund transfers or external support, that don't meet the definition of exchange revenues. So subsidies are now broken out separately to increase transparency and to highlight financial support not directly tied to the fund's core operating activities. As you can see here, we also included on the right-hand side just a small snippet of how the new statement of revenues, expenses, and changes in net position will need to be presented. Each caption, total, subtotal, all those are going to be required elements here to your statements to be presented. We have our operating revenues and expenses, and it comes down to your operating income or loss, all same as previously reported. But then we have a new section we present after that. It's the non-capital subsidies section. That comes down to another subtotal then, operating income loss and non-capital subsidies. After that, if there are any non-operating revenues and expenses, we'd present those here. Again, those are pretty similar to what we presented previously. May just have less items included here that may now be included in the non-capital subsidy section. Come down to your subtotal for income or loss before unusual or infrequent items, if any exist. Then we present those. And then come down to our overall change in net position. So pretty similar, just the new subsidies category. And then we'll go through some of those changes in terms of how those are being reported here. So Statement 103 addresses how we now categorize non-operating revenues and operating revenues and expenses under this updated guidance. So first, we'll start with the non-operating revenues and expenses. These are items not directly related to the principal ongoing operations of the fund. So those include like subsidies received and provided. Those are financial support from other funds or other parties and are now separately classified. Contributions to endowments. So these are donations made to or from permanent or term endowments. Financing related items. Common examples here would be interest expense on your debt. or any other items tied to your debt or your borrowings. You have your disposal of capital assets and inventory. Think gains or losses from selling off long-term assets or inventory that would fall into this category. And then finally, investment income and expenses. These are earnings or losses from investments, pretty typical, such as your interest, dividends, or market changes. And real quick, I'll jump back. Looks like there was a question I can address right here. Just asking for the definition of subsidies again. So Matt, if you want to go to the previous slide. Subsidies are amounts received to support an ongoing to support your ongoing operations, such as general fund transfers or external support that don't meet the definition of an exchange revenue. So broken out separately to increase kind of the transparency and highlight financial support that's coming in that's not really directly related to like your principal ongoing operations of the fund. So think like kind of like transfers in essentially are now considered subsidies. All right, so then we have, if you want to go back real quick, Matt, then we have the operating revenues section here. Ultimately, the standard defines operating revenues pretty broadly. Basically, they're just revenues and expenses other than non-operating revenues and expenses. What that really means is it would be those revenues that are, or expenses that are tied to the day-to-day services that the proprietary fund provides, like user fees, salaries, supplies. Ultimately, if it supports the ongoing principal operations of the fund, then it's considered operating. Next, we'll kind of go a little bit deeper dive into the definition of subsidies here. So subsidies are defined as one of three things: resources received from another party or fund for which the proprietary fund does not provide goods and services to the other party or fund. So think like non-exchange transactions there. And that they directly or indirectly keep the proprietary fund's current or future fees and charges lower than they would otherwise be. These could also be resources provided from the entity to another party or fund for which the other party or fund does not provide goods and services to the proprietary fund. Again, those non-exchange transactions, and that are recoverable through the proprietary fund's current or future pricing policies, and then also all other transfers. So GASB concluded the presentation of a subtotal here that includes these non-capital subsidies is needed in order to be informative for proprietary funds that receive subsidies on a regular basis, and to closer provide financial performance measures than the existing subtotals in those operating income and loss number, because this conveys now whether the entity is self-supporting or it's being subsidized to some extent. All right, finally, related to the presentation of the proprietary fund financial statements, we have sort of, I guess, choose your own adventure type slides here to determine whether or not your proprietary fund financial statements that previously were presented as non-operating revenues and expenses, if they would still be considered non-operating revenue and expenses, or if they now fall under this non-capital subsidies category. So first start out by asking if the revenue is non-capital or capital. If it's non-capital, go to the next question. Obviously, if it's capital, then it's not a non-capital subsidy, and you go to the next section. So next question then is does the revenue represent resources from another party or another fund? So you go to the respective question here, depending on your answer there. So if you go to question 3 then, if you'd answered it was from another party, you'd end up here. Does the revenue represent resources received from another party for which the proprietary fund does not provide goods and services to the other party? Again, non-exchange transactions. If it does, go to the next question here. If not, it's not a subsidy, and you can go to the next section. If you answered yes, though, number 4, does the revenue represent resources that directly or indirectly keep the proprietary fund's current or future fees and charges lower than they would otherwise be? If yes, then you have your answer. It would be considered a subsidy and would be presented here in this new section of the statement. If not, then it's not a subsidy, and we go to the next section. Number 5, this is if you'd answered to the Question number 2, if it came from another fund. Same kind of question though. Does the revenue from the other fund represent resources received for which proprietary fund does not receive goods and services? If no, then it's not a subsidy, rather it's a charge for service and it's an operating revenue. However, if you answered yes, then you go to question 6 and then ask the question, does the revenue from the other fund represent resources that directly or indirectly keep the proprietary fund's current or future fees and charges lower than they would otherwise be? If it's yes, then again, it's considered a subsidy. If not, then it's not a subsidy, actually considered a charge for service and going to be presented in your operating revenues. Next, we have the same kind of determination type questions related to those items that could potentially be considered non-operating revenue. So start with the transaction you're looking at. Is the revenue a contribution to a permanent or term endowment? If it is, you just stop here. It's considered a non-operating revenue as a contribution to a permanent term endowment. If you answered no, then go to the next question. Is the revenue related to capital financing from another party? If it is, again, you're done. It's considered capital financing or some sort of other revenue there within the non-operating section. If it's not capital, go to number 3. If the revenue related to resources from the disposal of capital assets and or inventory, if it is, then pretty simply, it's just considered the gain on disposal of capital assets and inventory in your non-operating revenue section, so no real significant change there. If it's not, then number 4, you ask, is the revenue related to investment income? Again, pretty simple here. This would just be your investment income if that's the case. Again, reported in your non-operating revenue section. And then finally, if it's non-investment income, you just ask, is the revenue related to transfers from other funds that are capital related? If it is, it would actually be considered transfers in capital related within this non-operating section. If not, then the revenue would be considered operating revenue. So looking at a specific example, going through these questions, just to kind of see how you can utilize these to go from kind of start to your conclusion there. I just picked out something like a grant revenue you received. So starting at question 1, is the revenue reflective of non-capital activity? It is. So you go to question 2. Does the grant revenue represent resources from another party or another fund in the reporting entity? It's from another party. So go to the next question. Does the revenue represent resources received from another party for which the proprietary fund does not provide goods and services to the other party? That's correct. So in this case, in this example, the grant they received funding for, they don't provide anything back to their party, so it would be non-exchange. And then ultimately, does the revenue represent resources that directly or indirectly keep the proprietary fund's future or current fees lower than they would otherwise be? In this case, we'll say yes, it does. The grant revenue indirectly keeps the fund's fees and charges lower because it's receiving the inflow of the funding, but do not require the additional outflows to generate those funds. So in that case, we would report this grant revenue as part of the non-capital subsidies going through those questions. Could play out differently depending on the answers to the questions that are provided. So good to go through those questions kind of thoroughly with the specific examples involved. And then lastly, again, to kind of close the loop here on the new presentation of these proprietary fund statements, here's an example directly from GASB. Again, you can see our categories, operating revenues and expenses, similar to before. Have our new non-capital subsidies category, and then finally our non-operating revenues and expenses. Ultimately, GASB was looking to update this presentation and reporting of these proprietary funds. So because they're considered business-like activities, self-sustainability is a key characteristic of your enterprise funds. So useful to determine if the fund's being subsidized to any sort of effect in order to continue to operate. So breaking those out separately was important in the GASB's mind here. So, and with that, I will then turn back over to Matt to cover the remainder of GASB 103.
Thanks, Tom. And just as a reminder, one of the things that was very specific is that as you're working through the decision tree on the revenues and expenses of where you're going to basically bucket these on the financial statements, is that the accounting as far as recognition of revenue or expenses, it didn't change. So well, what we're looking to do is just essentially going through and remapping the accounts and how they flow up into the financial statements, which GASB felt, of course, was beneficial. And in theory, it really isn't going to be all that difficult unless you've got a gazillion accounts in a very large enterprise fund. So a couple other things that 103 is doing, so we get that over. There we go. That's what I wanted to see. Is that when it looks to major component units, and we're talking about those ones that were what we consider to be discretely presented component units. The blended component units, that's not changing. So those are still going to be under the, blended component units are considered to be, special revenue funds or other types of governmental fund types that are incorporated into the reporting entity of the primary government, or it could be the enterprise funds as well. So when we're talking about these discretely presented component units, what would happen is that in some cases we would have a column for the for the component units, just one column, depending if you had multiple component units, and then in some cases there would actually be additional information of condensed financial statements and note disclosure in the note disclosures. Well, that's no longer allowed. What has to happen is that we have to break out those major component units separately in the government-wide statements, unless if we have, let's say 7 or 8 columns due to 7 or 8 major component units, then we can do an aggregated presentation on our statement of net position and statement of activities. But then following the fund statements, then we have to put in basically a breakout to show this information. And this is all in the basic financial statements. It's audited by the auditors. So we can't put this in the RSI. We can't do that anymore. It's got to be in the basic statements. So what that's going to look like here, I've got a pair of examples here. So this first one here, as you can see here, is that we have our column for our government activities, our business type activities, and the total that we normally do. But then now we have a separate column for those component units and broken it out specifically, so it's very easy for the readers to see what's what. So, and it's pretty basic, pretty simple there. Jumped ahead. So that's all we're really doing there. Not a huge change when it comes to this, because a lot of entities were already doing something like that too. Just the big thing is that anything was condensed information in the notes, that's out. Can't do that anymore. The next piece of 103 is looking at the budgetary comparison information. And this ties back to some of the changes that GASB did with the MD&A. As remember, if we go back, I'm not going to go all the way back to those slides, was that one of the sections that is currently in the MD&A is a discussion of the budget versus actual analysis of the general fund. Well, GASB is saying, no, you don't need to put that there in the MD&A anymore because it's all going to be in RSI. So that's one piece of the change. The other piece of the change was that when you have a budget versus actual presentation, the GASB 34 model allowed you to present budget versus actual as a basic statement before the footnotes or as RSI after the footnotes. GASB said, no, we don't want it in multiple spots. It's all RSI now. So depending on your jurisdiction, some places, some states will actually allow you, you can put it wherever. Some cases you have to put it as RSI. In some cases, that was actually part of the basic financial statements and was required by law. So those states have something to figure out specifically, because that's a change in the accounting principles that is going to contradict state law, and they've got to figure that out. So I'll tell you specifically in the state of Illinois, that's not the case. Typically, we see it as part of the RSI. So one, that's the other piece. The other piece of that is that we have to have variance columns. Now, we typically have variance columns. Now, variance columns were sometimes presented, sometimes they weren't. Now, yes, we are required to present variance columns on our budget versus actual. But then we have to have another variance column. The second variance column that is required is if we have a change in our original budget versus the final budget. We actually have to have a variance column so it's easy for readers to see what changed in the budget. Now, when you're doing the comparison of budget versus actual, that variance is only going to be final budget versus actual. So we're only going to have potentially two variance columns. And I've got an example that we're going to walk through, and I can show you how this works. The other piece of it as well is that we have notes to RSI. And typically, this is where we're going to be discussing information regarding the budget process and how that's going to work. When the budget information was included as a basic statement, that information was in the notes to the statements. Well, not anymore. Now it's all in the RSI, notes to RSI. That's where it's all going to be now. So the notes to RSI would describe the budgetary process, what has to happen, which funds have this, if we have any sort of overages of budget versus actual. And then also, what's going to happen now is that the notes to the RSI is going to explain significant variances. So that information that we took out of MD&A for significant variances, now it is in notes to RSI. So there's going to be a little more information that's flushing it out. So it's essentially taking what you're already doing and moving it to a different spot of the report. So as we jump to the next section, there we go. This is what I wanted. Okay, so this first example is the one where we have a situation where we have two budgets. We have our original and our final, and our first arrow that we can see, the one that's pointing, that's showing our first variance column. So you can very clearly see what's the variance between the two budget columns. And then the actual specifically says variance between the final budget versus actual. So it's very clear to the readers how we're doing this and how we're accomplishing the objectives to provide more transparency of what changed during the year in the budget, and then how that all played out to the into the final presentation as well. There's another option you can use as well. Let's say if you have a situation where you pass the budget during the year, but then you don't amend it because you didn't have a need to. So this is what we have here as well. One, you'll see our variance column between budget versus actual, budget versus original versus final is not present because we don't need to. Nothing was amended. So we're only going to show one variance column here. We're going to show budget versus actual. Now, traditionally said in RSI, like pre-GASB, pre-103, so in the 34 model, we wouldn't always see variance columns. Now we do. It is required. We have to show this information. Okay, so the final piece on GASB Statement 103 is taking a look at the statistical section. And it goes back to situations where we have our BTA operations and the changes in the proprietary funds, specifically with the income statement and how we've got our new categories for operating and not operating, and then non-capital subsidies. Well, what it's saying is that the statistical section, if you're presenting a statistical section, it needs to mirror what you're showing in those financial statements. So you don't have to go back and restate the statistical section from the past 9 years when you adopt it, but going forward, you have to show what it looks like so that to reflect the fact that we had a change in the reporting model. Okay, I think we are up to a polling question, so let's go ahead and pop that open. Go ahead, Chelsea. What do we got here?
Poll 2, after adopting GASB Statement 103, budget versus actual comparisons may appear in both the basic financial statements and the MD&A.
All right, let's see how well everybody was paying attention here. So, all right. Give her a few more seconds. I think we're trying to get to the was 90% the magic number we're trying to get to as far as our voting progress. Getting close. I get that in for your CPE. Couple more. All right. How did we do? Well, the vast majority of did get it correct. The answer is false. And the reason is that on Understatement 103, budget versus actual comparison is not part of the MD&A. It can't be an MD&A anymore. It has to be in the RSI following the footnotes. So, all right. I think we've talked about Statement 103. We've got 15 minutes left. I want to leave some time for questions. So why don't we dive into Statement 104? Tom, why don't you kick us off there, and then I'll take us home.
Sounds good. Thanks, Matt. So next we'll be covering the issuance of GASB's most recent statement, GASB 104, related to disclosures of certain capital assets. This was issued back in September of 2024. The requirements of Statement 104 are effective for fiscal years beginning after June 15, 2025, so same as GASB 103. Again, put our fiscal year end dates here at June 30th, 2026, December 31st, 2026, and then April 30th, 2027. Again, a brief synopsis of the objective of GASB 104 is to update disclosure requirements for certain types of capital assets, including right-to-use assets. So think of those related to GASB 87, 94, and 96. And also establishes criteria for governments to evaluate whether capital assets are capital assets held for sale. So the requirements for the statement is going to be applied retroactively for all periods presented, and they encourage earlier application of the standard. So if you're feeling inclined, you could be one of the first to take a stab at it. So with that, though, I will turn over to Matt to go through the specifics of the standard.
Thanks, Tom. Kind of like 103, I don't think we mentioned it. 103 is also, it is there. They are saying early adoption is encouraged. I will tell you in practice, I don't think any of us at Sikich has seen an early adopter. But not saying they're not out there. And this is another one it's another one where, yes, you can early adopt. And this one is the same thing. This is talking about disclosures. We're not talking about any sort of accounting or measurement adjustments when it comes to capital assets or what's in the basic financial statements. All we're doing here is just adding some additional disclosure information with information that we've already got anyways, because the accounting for these types of assets is already being done. So essentially what's going to be happening is that the first piece is addressing our capital asset roll forward footnote. It's one of the big ones that's out there. Everybody loves it. It ties back to the financials. And what's happening is that for 87, which is our lease standard, our right to use assets, and then for under GASB 94, which depending on your operations, you may have this, you may not, or GASB 96, which is our subscription assets. And what it's doing is that we're breaking out that information, whereas previously it wasn't required to be broken out in the footnotes. Now, there were disclosure requirements regarding for leases and SBITAs previous to this, as far as the asset, the historical cost of the asset, and the accumulated amortization. So you had to disclose this information anyways, but didn't necessarily have to break it out in the capital asset roll forward. Well, now you do. Although in practice, I will tell you that the vast majority of entities were doing this. They were breaking this out anyways. And there were all sorts of subtotals, and so you can break this out from your tangible capital assets to your intangible capital assets. So that's why the disclosure for the cost and the amortization is still required too. But again, it's basically taking what we've already got and just making it a little bit easier to read and understand. So what this is going to look like is in our example here is, as I mentioned before, pre-104, some entities were breaking it out. But now with this example that came strictly from an example client that we've got, we've specifically broken out the subscription assets for the SBITA and then the lease assets. The big thing is that when it says the lease assets, we said lease assets dash equipment. So it's very specific of what type of asset, because we're required to disclose this by major class of asset. Subscription assets don't typically have this as well, because subscription assets under GASB 96 is just software. So it's a subscription-based information technology arrangement, right? So the only we got is software. So we don't have to do major classes of assets because we only have one. So what we're doing here is that you'll notice is that 104 doesn't specifically call for subtotals by tangible assets and intangible assets. Now, you can still do it if you want to, but this presentation from GASB's illustrative example, it's simpler. And it does cover those requirements to show the ROUs from those tangible assets as well. So I personally like this disclosure here as well. I can get used to the subtotals as well, but the fact that you got the base information, you can tie it back to the financial statements. I like this presentation. It makes it a little bit cleaner from the presentation standpoint. So, okay. The other part of Statement 104 was again a disclosure for certain types of capital assets that are being held for resale. So, and that's GASB was very specific because there are instances where assets are being held and the government is looking to sell that off. Um, so GASB said, okay, if you're going to do this, that's fine. We're not making you change anything on the financials, but in the footnote, there's a couple of things we have to disclose. Before you get there, you have to evaluate the asset and determine if both of the criteria on the screen have been met. First thing is that, yes, they have decided to pursue a sale of said asset. They're going to sell it, right? And the other thing is that it's probable, likely to occur, probable. So that the sale is going to be recognized within 1 year of the financial statements. Yes, we're going to sell something, but we're going to do it, and we think in 5 years down the road. That does not meet the definition of this disclosure. So, and the nice thing is that GASB gave us a couple of items that consider whether or not a sale is considered probable. So some things we would consider. This is just a list. It's not limited to. There are other things that could theoretically be out there that GASB said, hey, it could be another indicator that the asset is probable to be sold. So available for sale and it's in immediate condition, meaning that tomorrow we can go and sell it and it's gone. It's off the books. We're actively looking to find a buyer, meaning that we're not just going to put it on the market. Are we doing something? Are we marketing this thing so we can actually sell it and get rid of it? The market conditions to actually sell said asset, and if there's any sort of regulatory approvals for asset, those have been met. An example of a regulatory approval for an asset sale would be as if you have grants that were funded with federal dollars, and kind of going back into the single audit mindset, usually when it comes to those types of assets, you usually have to notify a federal cognizant oversight agency that you're going to sell a material asset that was paid with their dollars. They need to give you permission. Well, if you have it, then you have met that criteria that you've got something that's going to be sold. So once you have determined that, what exactly are we disclosing here? So, well, what we're doing is that we're going to be disclosing the information separately in a separate disclosure about what is the historical cost and what is the accumulated appreciation. So it's a separate disclosure, usually a sentence or two, nothing too crazy. You don't have to break it out in your capital asset roll forward. GASB was talking about doing that, but they decided against it. So just a sentence or two to describe what's happening, the asset, the accumulated appreciation. Also, you're going to break it down into whether something is related to your governmental activities or your business type activities if you have assets held for sale in both of those reporting items. You have to reassess that held for sale criteria for each period. And then what you're going to do, though, this is not one of those standards where you implement it and you forget it. You have to continually reassess what's happening with that asset so that you can either continue to disclose it because you're going to include it within an asset, or did we finally get rid of it? So you have to continue. And if it no longer meets the criteria of an asset held for sale, because let's say one of those criteria is that yes, we want to sell it, but we can't determine that, we can't say that it's probable to be there. Well, you can't call it an asset. You cannot call it an asset held for resale. So then you do not need to disclose that information in the footnotes. Okay, so got an example here, which is going to be what we typically would disclose. This is taken specifically from 104's illustration, and notice how it's clearly listing out the activity, the governmental activity's impact, and how it's related to also revenue debt. Because one of those, if it's an asset and it's being pledged for collateral for revenue debt, you have to disclose that information as well. It's a specific little carve out. Also this disclosure picks up the cost and the accumulated depreciation. But if you notice, the note doesn't go much further than this because GASB's like, okay, we don't need to. So this is sufficient. So this is all we really have to disclose for this type of situation. Okay, we're getting close to the end of our time together, and we've got one more polling question to do. So why don't we go ahead and launch this one? So that's specifically dealing with the factors of whether a capital asset sale is probable, except for one of these things. Which one is it? So the asset is for sale post-upgrade. We're looking to buy that buyer. conditions are, we've met all the market conditions, regulatory. Which one of those is not one of those factors to say that a sale of a capital asset is probable? So let's keep going. We said I get about halfway through, so let's keep putting that in there. I'm going to get that in for everybody's CPE. And we got a question that's going to come in, and I will answer that question right after we're done with this. So let's give a few more seconds till we can get our CPE involved. It's getting close. All right. How'd we do? All right. Bruce paying attention, which is great. The first one is not the correct answer. The asset for sale after post upgrade is not there because the fact that that asset is not available for immediate sale. It's not, you can't sell it into immediate condition. So that is not a criteria saying that sale is probable because you have to do something first. So, all right, we've got, we did have a question that came through and we already talked about the definition of subsidy. So we were talking about that one. Okay, would GASB 104 apply if you're getting rid of fully depreciated 30-year-old office furniture? You're going to try and sell it, but if no one wants it, you're going to just donate it or junk it. That's not what 104, because in that case, the assets have fully depreciated. They don't have, basically, there's no useful life left on these things, and there's no more value per se. Under 104, you do not need to disclose that information. So we're talking about, let's say you are holding property, or that, maybe it was for a redevelopment, or maybe let's say another one, actually a better example would be, let's say that as part of your operations, you're running a golf course and you're going to sell, you're going to sell the clubhouse, or you're going to sell the land on this too. Well, that asset is, this still has value. That's part of your operations. That's what this standard is talking about. Not something where a fully depreciated asset they're just going to be disposing of as part of your normal operations. Okay, Chelsea, do we have any more questions that came through? I don't
I think we
see
do.
any.
Oh, no, I think we're good.
All right. So, all right. Well, thank you very much for everybody for your attention. We're right on time. So, we do appreciate all this type of stuff. Chelsea, anything else you got to throw in here to wrap us up?
At this time, I think we're good. Thank you so much, Matt and Tom.
All right, everyone. Take care. Have a great rest of your day.
Thanks. Bye.